Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Our next guest, a bit of a contrarian, I'm going to call her. She's not quite as bullish as some of our other guests have been about the outlook for equities in 2026. She's even talking maybe possibly a recession. I don't know. Let's talk it over with Kristina Hooper, Chief Market Strategist at Man Group. Kristina, great to have you here, and an early Happy New Year to you and your family. All right, let's talk about it. Are we going to be able to make this 4 consecutive up years by double digits in a row for U.S. equities?
Well, that's a great question, Alexis, and I think we certainly could see that, but I think we have to anticipate more volatility. And in fact, I would expect some kind of significant sell-off earlier in the year, foreshadowing an economic downturn, arguably a modest recession, and then a recovery. So I certainly think stocks, U.S. stocks could eke out gains next year, maybe even as much as a 10% gain next year, but it will not be an easy path to the end of the year. And I think that makes sense, just given the kind of gains we've seen thus far and also the kind of vulnerabilities we're seeing with the U.S. economy.
Talk to us about your economic call here, Kristina. What are you calling for in 2026? And kind of what are the drivers there that maybe some folks in the market might be missing?
So if we think about 2025, and there were 2 key drivers of economic growth, consumer spending and AI CapEx spending. And both of them could see significant declines in 2026. Let's take consumer spending, largely driven by higher income consumers. Certainly, they benefited from the wealth effect in 25. We saw how well capital markets did. Certainly, if that could change that could easily change in 26, especially if we do see a sell-off earlier in the year. But I actually think the bigger threat is an increase in unemployment. What we've heard from a number of companies is that they plan on layoffs related largely to AI, not entirely. That could easily accelerate and again tamp down consumer spending. Fear also can breed some reduction in consumer spending. And for lower and middle income Americans, of course, the issue has been affordability. That doesn't go away. In my opinion, I think it gets worse in 2026. It doesn't mean that inflation moves higher necessarily, but it means that they're still under the strain of higher than normal, above target inflation. So that can be very, very problematic since we've relied so much on consumer spending. And add in the potential for a reduction in or a slowdown in AI CapEx spending growth. This is an environment in which there are more vulnerabilities. Access to rare earth resources is questionable. Also, just the ability to continue the build out of data centers from a financing perspective, as well as perhaps legislative opposition. We're talking about we've heard from Bernie Sanders arguing for, a cessation on data center build out. We could see more opposition growing, especially with electricity issues. That was one of the big concerns coming out of exit polls in the New Jersey race this fall. So a lot could derail certainly the strength of both consumer spending and AI CapEx spending in 2026.
Yeah, that's a good point, especially with the midterm elections, right, Kristina? I mean, that's another big wild card that could affect things like regulation. I want to talk about precious metals, though, because we've been talking about it a whole lot, given the year that they've had. Spot gold up 65% year to date, silver up 150% year to date, copper up better than 43% year to date. Do you think there's still room in the portfolio to have these precious metals for investors, and to what extent in the new year?
So absolutely, I think those are important, although relatively small components of investors' portfolios perhaps should be larger. I do think there are a lot of good reasons why, especially when it comes to gold. I think what we're going to see is more concerns around growing deficits, not just a U.S. problem. This is a problem in a number of countries. Questions about fiat currencies. And growing interest and perceptions of gold as the go-to safe haven asset class. And what we know from history is that in almost every bear market, 6 out of 7 bear markets, gold held up better than the S&P 500. In most of those environments, produced a positive return when stocks sold off. 6 out of 6 corrections. So gold has been historically a safe haven asset class, and I think it will be even more so going forward. But it also has other drivers that mean it could perform well in a variety of different environments. I think there's a place for silver, but we have to recognize that the volatility we've seen this year could easily continue or even exacerbate in the future.
Kristina, we've had some really, really strong earnings in 2025. What's the earnings outlook for 26 in your opinion? And is that enough to support risk assets?
So I certainly think the outlook is, in my opinion, a bit weaker. I think, again, there are vulnerabilities there, especially when it comes to consumer-related companies, but not exclusively there. And of course, if one thing goes wrong, multiple things can go wrong. So I would anticipate tepid earnings growth. But again, I think that we're going to hear from companies that will relay to us in fourth quarter earnings calls in the first quarter, that the situation is getting more difficult, especially when it comes to consumer spending, and that there will be more layoffs. And I anticipate, again, there will be a lot of negative sentiment or increase in negative sentiment as we move through the early part of 2026. So I think, again, we'll see earnings growth, but I think it's going to be significantly lower than most anticipate as they sit here at the end of 2025.
Kristina, I want to touch on the bond market before we let you go. You said, I was looking at your note, you said you expect bond vigilantes to come out in greater force in next year. Why do you think that's true, and what kind of an impact might that have on, I guess, like the 10-year Treasury yield?
So we've certainly seen some hints of it in 2025 for the U.S., for Japan, for the U.K., for France. There are a number of countries that do not appear to be on a fiscally sustainable path. And I believe bondholders are growing more concerned about countries like the U.S. We saw some real hints of it, especially as the One Big Beautiful Bill worked its way through Congress because of the potential for increased fiscal deficits. So I think this is a year in which we're going to see some greater punishment. I think the yield goes up significantly, which can very well weigh down on stock prices. But I wouldn't be surprised to see the 10-year yield get close to or get to 5% in 2026.
All right, bringing us some fresh ideas for this market in 2026. Kristina Hooper, Chief Market Strategist at Man Group.
Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This economy, what's the economy going to look like in 2026? Inflation, job growth, economic growth. Let's check in with our next guest, Ian Wyatt. He's the chief economist at Huntington Bank. He joins us via Zoom. Ian, thanks so much for joining us here. I'd love to get your backdrop, how you're kind of framing out your economic outlook for 2026.
Yeah, we've really looked at it. We always like to look at it through a few key themes. I think one of the key themes we see is there's still largely a healthy consumer, but you kind of have that K-shaped split. So we do see households, when we talk to companies, we're seeing it in the data now. We were anticipating 3.5%, 4% raises coming to most consumers. You have Social Security coming in at almost 3% in terms of the COLA adjustment. You have a lot of people with, as you know, our previous guest mentioned, decent equity gains and potentially decent equity gains going forward. So you have that wealth effect for upper income households. However, for lower income households, we still see the stress. We see that delayed effect of inflation. If you think about inflation, really, it tends to hit with a lag for a lot of people, even if it's being measured in more of a linear basis. Like, we only buy a car every 3-4 years. So that, that rise in used car prices took a while to spread across households, as well as the rise in interest rates there. And we haven't seen that much of a decline in that area. So we see a healthy consumer. We think that drives spending next year. We think that drives growth. We're targeting 1.5% to 2% growth. And we think also, though, a little bit of a tight labor market keeps inflation somewhat elevated, 2.7, 2.8 next year. Part of that really is the immigration story. We think that's a huge story, and the implications are incredibly widespread. So that's another theme we've really been talking about this year.
Ian, are we going to see the immigration story, as you put it, play out in the jobs report coming up on January 9th and in subsequent jobs reports, do you think?
Oh, no question. When we talk to companies, it's kind of fascinating. First of all, it's the supply story. Although as we're seeing the unemployment rate ticking up, the supply of labor was growing at a tremendous clip. It's growing a bit slower. We think that slows consumption spending next year a little bit. So you have that, but you still get a little bit of a tighter labor market than at that lower end. So over the next few months, yes, we expect that it just limits the potential growth rate of the economy in terms of job growth. So that's one area. Another area, I think we're going to see a lot more automation. I was talking to a company that makes high-end lawnmowers, basically for golf carts, golf courses, that kind of thing. And they said, and this is not the only company where I've had this conversation, but only lawn mowing company. And they said, look, our golf course clients, they're interested in the automated mowers, the ones that basically operate without human interaction. And they're much less concerned about cost than they were a few months ago, because they're really worried that they just can't find the labor. And so at that lower end, in a lot of those manual jobs, we were an economy pretty reliant on immigrant labor. And so that's sort of playing out in a lot of different areas.
Ian, we're going to get the benefits of the one big beautiful bill, presumably in 2026. How did you guys kind of model that out?
We saw a couple of ways we're seeing that hit, and we've heard it from clients too. So it's a mix of what we're modeling, what's reasonable. We see that as maybe close to 0.4, 0.5% growth to GDP. You get a positive benefit, obviously, some lower tax rates. On the investment side, it's really a shift, I think, we have from structures to equipment. So in the previous administration, you had a lot of factors that were, the CHIPS Act, you had EV mandates, you had a lot of things driving construction activity and manufacturing. We had record manufacturing construction activity. So really a structure story, a building story. We see that pulling back. I think we've seen that in a lot of categories, and the construction activity's gotten pretty narrow. It's pretty much data centers, energy and power related to data centers, and infrastructure, because still some of the infrastructure money is out there and there's a lot of infrastructure spending. But otherwise, we see a lot of weakness in the construction category. But on the investment side, the one big beautiful bill in terms of equipment, the equipment side's pretty strong. We're hearing that broadly, that a lot of companies are looking at that immediate depreciation expense advantage. And we're seeing orders. I was in Pittsburgh a couple of weeks ago, and we had a client come into one of our RMs there saying, hey, I need $4 million before the end of the year because I want to lower my tax bill and I'm going to buy a bunch of equipment. And that's playing out. We see that as 0.1, 0.2% really driving a shift, though, in the investment mix. The investment mix shifting from structures to equipment.
Ian, as chief economist over at Huntington Bank, what's your outlook for rate cuts from the Fed next year? How many do we get, if any at all?
We expect, obviously, the pause. We'd anticipated, and we said, going into December, we said, one more cut and then pause. We thought that was pretty well signaled. I don't think we're any sort of miracle workers here. We're just listening to the Fed in terms of that kind of signaling. And when we saw the Fed minutes come out yesterday, that was confirming that idea that we're in the pause stage now. If we look back to 24 and 25, we had pauses at the beginning of the year. Those didn't end till September in both cases. We don't think it lasts that long, this pause. We expect one more cut come March. Then, of course, Powell's term ends in May. We think there'll be a couple more cuts likely, so it probably puts us right around 3% over the course of the year. But if we look at the forecast, if we listen to the Fed governors, we're getting pretty close to that neutral rate. And what that neutral rate means, of course, is that the Fed really views it as they're not stepping on the gas for the economy, they're not hitting the brakes for the economy. They're just sort of letting it glide. We're in a glide path. Right now, they still think they're hitting the brakes for the economy. And as we get closer to that neutral rate, we think the Fed governors, some of those governors who are really open to cuts now, are going to become more resistant. This is going to be a more hesitant Fed. We still expect, partly because of a somewhat tight lower end labor market, especially in areas like healthcare, services, when you're talking about lodging, restaurants. We think that those wage increases are going to keep pushing up some price increases across the board. And that's roughly a third of the CPI is the services we were talking about there. So we expect that plays into a couple more cuts this year. Still, you have a pretty soft labor market. That gets the Fed moving. The Fed really cares way more about the labor market than the stock market. And that gets them to do a couple more cuts. But we think, you get close to 3, you're really at that neutral rate where some of those dovish voices maybe get a little more hawkish.
Yep. All right, Ian, thank you so much. Appreciate getting a few minutes of your time. Ian Wyatt, he's the chief economist over there at Huntington Bank. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Eric Sturtevant, Chief Investment Officer, Apollon Wealth Management, joins us here in studio. He's going to be down there in Times Square here later on tonight at the ball drop, so a lot of fun down there. Eric, thanks so much for joining us here. What's the conversation you're having with your clients these days about setting expectations for 2026? We had 3 years of double-digit returns for the equity markets. The bond market's been really good for investors. If they had some gold or silver, even better. How do you set expectations for 26?
Yeah, we've certainly been very spoiled the last 3 years with very strong returns coming out of S&P 500. But we're talking to our clients and just reminding them that while we know the market breadth has been very narrow for the past 2 and 3 years, we expect that to broaden out. And between value stocks, large cap value, small cap, international. So now's not the time. Now's a good time, I should say, to rebalance the portfolio and to take a little off on the technology side, because I think there's plenty of sectors that have really strong returns going into 2026, both domestically as well as international.
Yeah, I'm glad you mentioned international as well. And Eric, give us, if you can, some specifics. I love specifics when guests can come on and join us, but names or ideas, sectors outside of tech.
Sure. Yeah. I mean, so within, maybe I'll start off with domestically of some sectors I like, if that's okay. Financials had a tremendous year, and I expect, there's a little bump in the road when Jamie Dimon made that cockroach comment and
about the credit at Tricolor and First Brand. Yeah, exactly.
But I don't think there's any evidence of widespread concerns there, even within the high yield market. We see investment grade, levels within high yield. But I think financials, just with the interest rates coming down, I think we're going to see some more M&A activity pick up in 2026. In fact, during the government shutdown, more than 900 registration statements, including IPOs, were filed with the SEC. So I was already expecting a big year in M&A activity within financials, but now even more so as they work through that backlog. And then another sector that really got its legs in the fourth quarter is healthcare. And healthcare has just been stuck in the rut for a long time. And it typically does with the new White House administration, just because there's so much policy uncertainty. But I think we're starting to get past that. And I think it's great with healthcare is that it's traditionally a defensive play, but I think there's so much innovation in there. Besides the AI, I think the weight loss drugs are the second biggest innovation in the markets right now. And there was a bottleneck in drug supplies there earlier in the year. That's been cleared. A lot of these biotech companies made a deal with the White House where in exchange for lowering prices, they're going to get more weight loss coverage with Medicare and potentially Medicaid. And that opens up those weight loss drugs to 40 million more people. And that industry is expected to be $150 billion by 2030. So I think that's another sector that I really like going into 2026. And then on the international front, the valuations are still very attractive compared to U.S. stocks. Specifically, I think Japan is just such an incredible story and still plenty of legs to go. And many people are surprised if you look at the past decade. Earnings per share, cumulative earnings per share for Japanese companies are up over 250%, which exceeds the U.S., Europe, even the U.K. And now with Prime Minister Takashi bringing in some more pro-growth policies, I expect stronger returns or more strong returns coming out of Japan.
Yeah, I mean, international's been the place here as good as the returns have been in the U.S. If you look at EMEA, much better returns here. I mean, led by Spain, particularly when you adjust for currencies. Spain, adjusted for the currencies, up 70% this year. Just extraordinary. And we're seeing double-digit gains across Europe and a couple of the Asian markets, including Hong Kong. How about emerging markets here? I think the chatter around emerging markets has just kind of gotten a little bit louder and louder and louder over the course of 2025. And people were talking about that a little more. How do you guys think about that?
Yeah, I expect those returns, again, to still have some more legs to them. I mean, typically you see emerging market because a lot of their debt is U.S. denominated. When the Fed starts easing, you could see emerging market equities rally. We're certainly seeing that, especially with the U.S. dollar depreciation. And we know this AI revolution is worldwide phenomenal. So some of those tech really centric nations, especially outside of China, are benefiting of some of these companies redesigning supply chains away from China, are benefiting. And even countries like Mexico, as we're looking for more nearshoring opportunities with the U.S., have benefited. So I think we could still see some strong returns out of emerging markets going forward into 2026.
You talked about lower interest rates being a tailwind for financials. They could also be for the small caps. Russell 2000, taking a look here on the Bloomberg terminal, up 12% year to date. Not too shabby. I mean, underperforming the other major indexes, but still solid, respectable gains there. Even more so. What's your outlook for the small caps?
Yeah, I think 2025 was the big year when international made a comeback. I think 2026 could be the big year where small cap makes a comeback. And it didn't have a bad year, like you said. I mean, the Russell was up. I think we could see stronger returns. It's just that's a very interest rate sensitive sector. We know the lagged effects of all the rate cuts and potentially maybe 1 to 2 more rate cuts. All the benefits to domestic companies with OBBA and deregulation. You know, these smaller companies have higher costs from a regulatory perspective. But the one thing that will continue this rally is really it needs the earnings. And right now, the earnings estimates are expected for small cap companies to be up 60% this year. Now, in the beginning of the year, it's typical for small caps that, you know, they temper down those expectations. And you look at the last 20 years, the projected earnings growth versus the actual earnings growth is about negative 20% for small cap stocks. So if we're projecting 60% earnings growth for small caps, and let's say we deduct that 20% as throughout the year, we may see those expectations lower a bit. That's still 40% earnings growth rate among small cap companies if that holds to the average, which would really continue to drive this rally. The one item that I would just make noteworthy is that I am surprised that the Russell 2000 has outperformed the S&P 600, which is another small cap index. Russell 2000, 40% or so companies unprofitable, while S&P 600 it focuses more on profitable companies. I expect that to reverse this year because I think there's going to be some bumps in the road. And I think we're going to see some heightened volatility in 2026. But overall, I remain bullish, and I would just advise advisors to lean more into that quality factor, companies with solid earnings, solid balance sheets, and solid cash flows.
What do you, at your firm, is it pronounced Apollon?
Apollon, yes.
Apollon. Yes. Do you guys have a view on alternative investments and maybe what percentage that should be of a typical client's portfolio?
It varies. Okay. Certainly for our Apollon models, we design models more just on the public market asset classes. And then for very specific client situations, that's when we look to potentially incorporate private investments into our portfolios if they can afford the illiquidity. I'd say a good portion of our clients do have some private investments in their portfolios. We think we like to take our typical asset allocation portfolio, and then we basically substitute some of those asset classes in. So we may complement the fixed income allocation with private credit. I mean, over the last 10 years, the yield for the Bloomberg Barclays Ag is about 3%, but private credit is a little over 10%. So for clients that are entering retirement, that's why we think private credit could really boost the income. And then we know there's less publicly traded stocks in the markets right now. So that's why we think there's great opportunities in private equity. Companies are staying private for longer. So we like to complement small cap exposure with private equity. So for our higher net worth clients, a high majority of them do have those private investments. But we really consider that a client by client basis as opposed to creating portfolios with alternatives already involved or allocated to them.
Eric, thank you so much for joining us. Really appreciate it. Eric Sterner, he is Chief Investment Officer, Apollon Wealth Management. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Our next guest says residential real estate 2026 will be a transition year and not a turnaround year. Let's see what she means there. Lisa Sturtevant joins us. She's a chief economist for Bright MLS. Boy, Lisa, housing affordability has been the challenge for would-be homeowners out there. Talk to us about kind of where we are as we enter 2026.
Yeah, housing affordability has really been the major constraint on the housing market, and we're starting to see affordability improve a little bit, right? We've seen mortgage rates come down a little bit at their lowest levels as they've been all year. We've seen price growth slow a little bit, which has also helped. And so that's made affordability a little bit easier. But boy, it still is a big challenge for those who are still trying to get into the market. First-time buyers, moderate income buyers are still facing a really big challenge in the year ahead.
So what do we have to look forward to if you're wanting to get in a first-time home buyer, which we know I think the average age now of a first-time home buyer is close to 40 in this country, which is hard to believe. And lots of folks have given up on owning a home dream or delaying, lots of life milestones just because they cannot afford that home. Is that going to change in a meaningful way and in the new year? And if so, what parts of the country should those folks be looking at?
Yeah, you're absolutely right. This idea of becoming a homeowner for first-time homebuyers, it's all tied up with all sorts of other life milestones, right? That people are either delaying or sort of taking another look at. And I think it is going to get easier for first-time homebuyers, but not in every market across the country. There are places where inventory is still very, very tight, places in the Midwest, places in the Northeast, where it's very competitive, where homes are still selling above asking, where there's still multiple offers on homes. Other markets, though, parts of the South, parts of the Southwest, we're seeing a lot more inventory and, frankly, a lot more leverage for buyers. And that's where first-time buyers, I think, are going to have a little bit better options in the year ahead.
That's what I did. I left the metro New York area and went to Richmond, Virginia to get my first home. It's affordability, as you mentioned, Lisa, is a key issue here. But it's also, if someone's going to buy a house, they have to feel pretty good about the economy. They have to feel pretty good about their jobs. Is that a tailwind or a headwind here in this marketplace?
Yeah, I'm really thinking about it as a little bit of a tug of war. In 2026, we have lower mortgage rates, slower price growth, really bringing people into the market, making people want to get into the market, improving affordability. But at the same time, there is a lot of economic uncertainty. We're going to get some new jobs numbers here next week, but people are feeling more uncertain about their own economic situations. And when people are feeling uncertain, they're less likely to do big things like buy a home or sell a home. And so there's going to be a push and pull between these economic anxieties and these more favorable affordability conditions. And right now, frankly, I don't think it's clear which one's going to win out.
All right, let's talk mortgage rates because they are a part of the affordability issue. Paul, you said a moment ago, 6.3% on the fixed 30-year right now. We were at 7% at the beginning of this year. What's the range, you think, for the 30-year and the 15-year? That's popular for folks looking to refinance in the new year.
Yeah, our forecasts are for the average rate on a 30-year fix to stay above 6% in 2026. I think there are some forecasters who are saying that rate will dip below 6%, but I think there's a lot of unknowns still. And so we're going to be watching. I think the key thing is for homebuyers to not try to time rates, think they can time them, or they can look at ways to sort of maneuver it. I think you have to decide when is the best time for you to buy. But let me on the thing about affordability, though, even if rates were at 6%, let's say, at a $410,000 home, you still need an income of about $115,000 to qualify. That's much higher than the median household income in the U.S. and really highlights how out of balance between income and home prices we've gotten over the last few years.
Why don't we just build more houses?
That would help, right? And so I think increasing the supply would help, but it's not just about supply. We hear those high-level numbers of what the housing supply gap is, but we need to build homes in the places that people want to live, right? Where there's job growth, where there's economic opportunity, and those are the places where we need to see more homes be built. We also need to see whether there are ways to free up homes by encouraging people who want to sell to actually do so, to get out from a mortgage rate that they don't want to give up. So I think there are ways to increase supply, and that would help the affordability challenge.
What do you do to incentivize somebody to want to sell their home, especially if I'm not going to call it a buyer's market in 2026, but if it starts to move in that direction, what gets somebody out of their house?
Yeah, so I think there's a couple ways to think about it. I mean, one is some people aren't moving because there's nowhere for them to go, right? Folks who might want to downsize don't see anywhere to go. So that gets back to that, let's build more housing for people to downsize into, folks who are retiring and so on. But there may be other ways to provide incentives, tax incentives or other incentives that could encourage people to sell the home, maybe so they're not hit with a big tax bill if they've got huge gains in the equity of their home.
Yep.
There may be ways to encourage people to sell there, but it's really going to be at the margins.
Yep. Lisa, thank you so much for joining us. Always appreciate getting some of your thoughts. Lisa Sturtevant, Chief Economist at Bright MLS.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.